Imagine this. A self-made billionaire wakes up and decides to take out a massive loan. Not because they're in any trouble, but to get even richer. You know, for most of us, the word debt just screams danger. It's a burden. It's a problem we need to get rid of, right?
I mean, we're told our whole lives to avoid debt at all costs. But then you look at the wealthiest people in the world, and it seems like they're playing a totally different game. They don't see debt as a liability. They see it as one of the most powerful tools out there for building wealth. So what on earth do they know that the rest of us don't?
And that leads us right into our first section, the debt paradox. We're going to dive into this huge gap between the financial advice that's given to everybody else and the actual strategies the wealthy are using every single day.
This is the big question, isn't it? It feels completely backward. If you have millions of dollars, why in the world would you go out and borrow more? Well, the answer really pulls back the curtain on a fundamental secret about how money actually works.
Okay, to make this super clear, let's just tell a story. A tale of two investors. We'll call them Alex and Brianna. They start in the exact same spot, but one tiny decision sends them down two radically different financial paths.
So here's the setup. It's pretty simple. Both Alex and Brianna, they've each got a $30 million investment portfolio. They had a great year, and now they both owe the exact same amount in taxes on their gains, $3 million, an identical starting line.
Okay, now here's the fork in the road. Alex does what most of us would probably do. He sells off $3 million worth of his investments to pay that tax bill. It's the sensible, debt-free choice. But Brianna, she does something totally different. She doesn't sell a single thing. Instead, she walks into a bank and takes out a $3 million loan using her big portfolio as security.
And boom, this shows you the immediate difference. You can see Alex's portfolio has already shrunk down to $27 million. But look at Brianna's. It's still sitting at the full $30 million. Her money is totally intact, completely untouched, and it's still compounding, which means it's growing on the full original amount. She just used someone else's money to pay her bills, keeping all of her capital in the game.
So, how is that even possible? And why is it so incredibly powerful? This is where we get into the actual toolkit that the wealthy use to just amplify their gains, and it really all boils down to a few key principles.
The first, and honestly the most important concept, is leverage. In simple terms, it's just using borrowed money to make more money. It's what allows you to control, say, $1 million asset with only $100,000 of your own cash. You're using the bank's money to multiply your potential returns.
So, let's see leverage in action. The math here is really simple. Step 1, you borrow money at a low rate, let's say 5%. Step 2, you turn around and invest that money into an asset that's growing at 15%. Step 3, you just profit from that 10% difference. You've just made a solid profit on money that wasn't even yours to begin with. That's the engine of this whole strategy.
Now here's where it gets even more interesting, kind of mind-bending actually. We're all taught that inflation is bad, right? It chews away at the value of our cash. But if you have fixed-rate debt, inflation suddenly starts working for you, not against you.
Let me break that down. When you take out a loan, your interest rate is locked in. It's fixed. It does not change. But as inflation ticks up year after year, the actual value of each dollar goes down. So the dollars you use to pay back that loan in 5 or 10 years are worth less than the dollars you borrowed today. You're literally repaying your debt with cheaper money. So here's the crucial point. Selling an asset is a taxable event. It shrinks your capital base. Borrowing against that exact same asset is not. You get all the cash you need for taxes, for a new investment, for whatever, and it's not considered taxable income. Your wealth-generating machine stays intact and keeps on humming.
Now hold on. I have to make something absolutely crystal clear here. This is not about going out and maxing out your credit cards. There is a whole universe of difference between the debt that traps you and the debt that can set you free.
Bad debt. That's what we usually think of. It's debt you use to buy liabilities, things that go down in value over time, like a car or a new TV. This stuff is constantly taking money out of your pocket. Good debt is the exact opposite. It's used to buy assets, things that go up in value or produce an income, like a rental property or a business. This kind of debt is designed to put money into your pocket.
And this, right here, is where most people go wrong. Using good debt effectively requires just absolute discipline. The money you borrow has to go directly into an income-producing asset. Every single dollar that asset generates should go toward paying down the loan or buying more assets. Not a new watch, not a vacation. Without that discipline, good debt can turn bad really fast.
So let's bring this all together and kind of flip our initial assumption completely on its head.
We started out thinking of debt as the ultimate risk. But what if the real risk is actually something else entirely? Think about it. In an economy where money is literally designed to lose a little bit of value every single day, just letting your cash sit there is a guaranteed way to lose your purchasing power. Falling behind is the default setting. So the person who strategically uses a loan to build their asset base, they're actively fighting against that decay. Let's look at a quick, concrete example. If your money is sitting in a savings account earning, say, 1%, but inflation is chugging along at 3%, you aren't really earning 1%. As you can see here, you are losing 2% of your wealth every single year. That's the silent tax of inflation, just eating away at your money.
So you see, the question isn't whether debt is good or bad. The real question you should be asking yourself is this: are you using debt to buy liabilities that just make you poorer, or are you preparing to use it to acquire assets that build real, lasting wealth? The answer to that one question, well, it changes everything.